Welcome back. This is Open Exchange, and we are coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, in a few minutes, we'll be getting the pre-open rate. So let's get in a couple of derivative strategies. Manoj Muralidharan joins us to help us out with exactly that. Hi, Manoj. Morning. Thanks so much for joining in. Monday morning, how are you approaching trade? What are the strategies and stocks?
Good morning, Nigel. The only difference that we look into this next 3 to 5 days, obviously it's a monthly rollover, and if you remember this uptrend that started into the April series, there was positioning into the May contract as well. That is the open interest. We had seen it, I guess, the last week of March itself, where being positioned in May. So we believe that this uptrend has more legs. Now, the single intraday activity that happened on Friday, I would say that would be call selling at 17,700 strikes. So 17,730, that becomes the resistance for the day. Once that is breached, which we expect might happen, then there is a good possibility of 17,800. So this would be specifically intraday view that we have. Now, for the bank Nifty, obviously, we believe that 42,400 on spot, that has been a resistance where the supply has come in. So once we see a breach of that, it opens up a good 800 more points in the upside as a target. So long rollovers into these two indices can come in. Stock specific, I guess, Bazaar Auto is holding good and the stock has good potential. So, but we would ask to get a trade into the March futures, not really get into an April one. So somewhere close to 4,300, it becomes a buy with a stop loss of 40 to 40, and the May series we're expecting at least a 4,400. So 4,380 to 4,400 becomes a target. And in the bank Nifty, we believe that the PSU part, especially stocks like SBI, has shown good buying and follow-up buying. It's happened into this consolidation as well. So go for a 550 strike May option. I guess it is closer to 10 to 12 rupees. The potential is good. The target can be a good 24 on that. The stop loss should be 300 option.
Okay, thanks a lot for that, Manoj. For all of those ideas as well as your view on the markets. Appreciate your thoughts. Well, let's move on. The Reserve Bank has offered HDFC Bank relief on priority sector lending norms and has permitted the merged HDFC entity to hike stake in HDFC Ergo and HDFC Life to over 50% before the effective merger date. Ashutosh Mishra, the head of research institutional equities at Ashika Stock Broking, joins in. Prakash Diwan is also sitting by with us. Ashutosh, let me come to you first. What does this mean for HDFC Life? The stock has had a large underperformance, compared to the market, compared to its peers over the last many years. But from here on, what do you see as the stock move?
So I clearly see as a positive development for HDFC Life and HDFC Ergo both point of view. That now investors clearly know that the HDFC Bank will be holding 50% and they will also get benefit of the cross-selling to the HDFC customer in a bigger way because now they are direct subsidiary to the HDFC Bank. So in my view, this is very positive development. Yes, industry will be facing some issues on annualized premium equivalent because fourth quarter was very good. So compared to the fourth quarter, number may not look good in the first, second, or a few other quarter in the coming years. But we are going to see one of the largest concern getting addressed by this clarification from RBI.
Hi, Ashutosh. Morning. We had a good update that came in there, from HDFC Life. The stock had opened up well in the green, but the street seems to suggest that the good performance, because of the changes in the budget, could put FY24 growth at a risk. What are you factoring in for FY24 for HDFC Life?
Yeah, so FY24 will be a bit lackluster for the HDFC Life as such. The reason is purely that fourth quarter we have seen the type of AP growth which a few of the insurance company which has come out with the results is clearly indicating that everyone has delivered a very good number in fourth quarter, and all the regulatory changes has been kicked in from the 1st of the April. So the FY24 will be more of a consolidation year for them. And going forward, the future prospect looks good. Yes, we are going to see some more tax changes in the future, but I don't think so that is concerned at this point. I don't think so that is a concern at this point of time. So, in my view, this is more of a positive for the bank, for the HDFC Life at this point of time.
Prakash, can I get a view on HDFC Bank from you? We discussed the insurance, the life insurance company with you, but bank itself, I mean, what does it mean, what the RBI has told them now?
No, so what it does is it takes away a huge burden, potential burden from HDFC Bank's perspective to kind of, match up to those PSL, private sector lending allocations in a very short or a very near-term basis. it gives it enough time to be able to calibrate that. And, the change that's not been allowed is the CRR, SLR requirements have not been tweaked, which is fair enough, because for a large balance sheet like this, you can't take those kind of risk and add to the systemic risk in the entire system. But my sense is the priority sector lending tells you that they'll be able to focus more on the more lucrative businesses of corporate loans, of retail, and that's exactly where the margin improvement will happen much faster than what was expected. So what the street is going to do, Prashant, as we get closer to the effective merger date, the banks' net interest margin improvement, which is potentially likely to happen given the cost of funds lowering because of the combined entities' ability to raise low-cost money, that with the focus on retail and corporate and SME loans is going to be a very good combination. So what ICICI Bank has eventually done in these last 4 quarters, if you see, is something which HDFC Bank would do, and it's probably been holding itself back because of this merger. So that just goes out of the way. I think it's going to grow at a scorching pace once the merger takes off. And then this actually helps it do without looking back or over its shoulder in terms of, hey, I want to need to do priority sector lending of this much. There's no restriction that will pull them back.
So for HDFC Life, right, I just want to pull up the stock because there are some brokerages that have upgraded the stock as well. MK has upgraded the stock and they have a target price of 650, which is well above the current market price. Prakash Diwan, your thoughts here? I mean, now that the overhang is out of the way, do you think HDFC Life can correct the underperformance it's seen over the last year or so?
No, absolutely. And, a couple of days back, we were talking when Yash came up with this report in terms of why the last quarter was so lumpy, given the imminent regulatory change from 1st April. And Ashutosh also alluded to that. My sense is, Sonia, all of that will probably get digested in the next couple of quarters. Then you'll come back to a normal state of growth for most of these larger players, which have great distribution strength. Now, just imagine HDFC Life. One is everybody who wanted to buy a block of HDFC Life being sold by the parent, given this merger impact, is now going to be buying it on the screen. Yeah, so that's very clearly going to keep demand in place. The second thing that's going to happen is the expectation of AP, steady kind of growth not being there, or base effect coming into picture and all of that, is also means that people will not buy it at this levels, and that's where it starts offering a lot of value. So the moment you start buying a stock which is going to do well only in 12 months or beyond 12 months, you start deriving a lot of value, not overpaying for it. So at 550 or 540, whatever, I don't know what it is opened up, it's definitely going to offer you a very significant upside from a large cap business in the financial services. So I'm quite positive on it. I would be surprised if you see those 650, 700 levels in the next 12, 24 months.
Okay. Ashutosh, thanks a lot for joining in and talking about this issue. And Prakash Diwan, thanks for commenting on HDFC Life as well. But before the pre-opening rates kick in fact, they have kicked in right now. So let's just take a look at the first numbers. For the headline index, it looks like it's going to be a good start, almost 80 points in the green. The stocks to watch out for: HDFC Life, big mover this morning, so 7% higher on that stock. That overhang is clearly out of the way. The other two heavyweights are ICICI Bank and Reliance Industries, both batting for the bulls this morning. ICICI Bank is up about 2% while Reliance is up almost about 1%. Before we talk about more numbers, Prakash Diwan, just one more point on Reliance Industries that we made a mention of briefly, but I think assumes more importance through the course of the day, is the way they've managed their debt, right? So the net debt to EBITDA, despite all the capex, is still below 1 time in FY23, even if you account for all the additional liabilities, payable spectrum, etc. And the company is now confident that they will maintain their net debt to EBITDA below 1 times despite capex. Do you think that's something that could give an additional fillip to the stock, or is it something that's already been priced in?
No, I don't think there's so much of goodness in the numbers in Reliance which has not been priced in. It's just languishing out there at these 2,300 levels, where if you do SOTP, and then I was very happy to hear you ask some of the previous guests on the retail side of the business. That's where 3,300 stores in a quarter, Sonia. I mean, we're talking about some of these chains don't even have that much in their lifetime. And you have a 65 million kind of square feet, which is already there. The moment they, get to those scales that they have put milestones on or targets on, without, this debt going beyond that 1%, 1 time, it's very simple. You have a balance sheet that's not likely to get stressed, whereas you'll have growth coming into the P&L very soon, and retail has already proven that. So my sense is O2C firing on all cylinders, gas, E&P, petchem, everything, refining, and retail doing so well. Telecom, of course, a price hike and things could change dramatically. I don't see any reason why, Reliance could probably be stuck at this zone of 23,000, 2,400. So it has to move. It has to move. It's just a question of when. So, patient investors will definitely get rewarded if they look at it from that perspective.
Okay, all right. Prakash, thanks so much, Prakash, for stopping by. Wishing you a good Monday and a good week ahead as well. But it's 9:10 a.m., so let's go across to our technical experts. Sudarshan's back with us. Sudarshan, what's the 9:10 call?
Berger Paints. Berger Paints is a buy with a stop under 570 and, of course, long in the Nifty.
Okay, all right. Thanks, Mitesh. Thanks, Sudarshan, for that. Mitesh, let's come across to you.
I will also have a paint stock. Asian Paints is a buy with a stop at 28.55 for targets of 29.40.
All right, gentlemen, thanks a lot for that. By the way, I just want to mention a couple of more stocks. Macrotech developers, we already got the Q4 update a while back, but the numbers have come through. The guidance is pretty strong, so Macrotech developers will definitely be in focus. And of course, ICICI Bank is your big mover as well. Abhishek is here to give us the latest on that. Abhishek, splendid numbers this time.
Well, yes, Sandeep Bakshi has created history for ICICI Bank at records galore. So the net interest margin is at all-time high. Domestic net interest margin has crossed the 5% level. NII growth is one of the best in last 8 years, coming in at more than 40% YOY, which has aided the PAT to be the highest quarterly PAT that ICICI Bank has seen. So the return ratios are also splendid. ROA of 2.4% and ROE of 18.9% are the highest quarterly return ratios that you are seeing. Asset quality, one of the best in last 8 years or even more. The unsecured book, that's the highest in terms of percentage of the loans, 22-quarter high over there, coming in at 19.4% of the loans, and that is why the net interest margin continues to remain robust. On the flip side, the deposit growth YOY continues to remain at around industry level of about 10.9%, and going ahead, management has indicated that the net interest margin could moderate. However, in terms of P&L performance, both the NII and PAT is ahead of our poll. Now, brokerages remain upbeat on the stock. They say that ROE will increase to 17 to 18% in next 2 years. They have raised estimates between 3% to 9% over the next few years, and they see uptick in deposit mobilization to be a plus and expect it to aid the loan growth that the management has targeted. Now, management has targeted 18 to 20% loan growth in FY24. Operationally, it's an inline performance and market share continues to remain strong for ICICI Bank. So brokerages across remain positive on the stock. Target price ranging from 1,100 to 1,200 per share. Back to you.
Okay, thanks a lot for that. But it's clearly ICICI Bank and Reliance that could bat for the bulls this morning, and HDFC Life as well, which is your big Nifty gainer. So on Reliance, let's just put together some brokerages. The views are positive post the numbers. Morgan Stanley says that the company beat street estimates. It's the energy vertical that drove the EBITDA beat. But Kotak Institutional Equities also puts focus on the retail business, which is growing at a scorching pace. They reiterate buy with a revised target price of 2,800. They say that the company added 800 new stores in Q4 with a total addition of 3,000 stores in the fiscal, which means that the retail store footprint is now over 18,000 stores, which is a 20% growth compared to last year. Jefferies has upgraded the FY25 EBITDA by 3%. They say that it's the retail scorching space addition which should add the EBITDA by 30% compounded growth rate. Now, the other big positive is the fact that despite all the capex, the net debt has remained flat, and Motilal Oswal points that out, where they reiterate a buy with a target price of 2,800, and they say that the entire capex was funded internally, and hence the net debt remained flat quarter on quarter, and that's something they liked. Finally, JP Morgan remains overweight with a price target of 29.60. They say that the risk reward is attractive and the stock's underperformance that they've seen is unwarranted at the moment. So
okay, all right. Thanks a lot for that. Sonia, well, Rima joins us to tell us about Wipro. They've announced a buyback. Rima?
Thanks so much for that. So Wipro has said that when the company, the board meets for considering the numbers on the 27th of April, they will also consider a buyback. Now, this will be Wipro's fifth buyback in the last 7 years. Last year, the company did not do a buyback because they were focusing a little more on their M&A acquisitions. Now, JP Morgan estimates the buyback size could be $1.2 to $1.5 billion. Morgan Stanley says, based on the past buybacks, the range of the buyback could be from 6,500 going up to 10,500 crores. The cash in the books is ample at $2.7 billion. The past three buybacks by Wipro have been tender buybacks. So that's what the street is anticipating, because in a tender buyback, the promoter can also participate. The good part about a buyback right now, at least, is that it can lend some support to the price in case of stock volatility or uncertainty or weakness, given the current environment. Back to you.
Okay, thanks a lot for that. So just about getting ready for the market opening, and lots of stocks and lots of triggers actually that could aid the market. But will it take the markets out of the range? Time will tell. For now, 85 points in the green for the Nifty. HDFC Life is your top gainer. ICICI Bank posts stellar numbers. Wipro posts the buyback, and Reliance after a good set of numbers. You also have a lot of earnings coming through this week. There's Indices Bank that comes out today. There's the Bajaj Auto tomorrow, Maruti day after. So the market has plenty of cues to latch on to. And this will be the first set of auto numbers which will give you an indication whether, the trend is on the upside or not, followed by which you'll get FMCG numbers with HUL as well coming through on Thursday. So it's an action-packed week and looks like the market is going to open well in the green. So here's the first tick that we're getting on the index. It is well in the green, 80 points higher now on the Nifty. Whether it sustains, we'll get to know in a while, but for now, the first tick is positive. It's led largely by HDFC Life after that overhang is removed, so 6.5% higher. Wipro on that buyback is up 1.5%. ICICI Bank on strong numbers is up about 2%, and Reliance on good numbers and no further debt elevation is up almost about 1.5%. Apart from that, HCL Tech, Apollo Hospitals, Indices Bank ahead of its numbers today is in the green. So these are some stocks that are well in the green. The mid-cap index, by the way, is trending in the red. So there's a little bit of volatility in the broader markets. On the downside, Sun Pharma, Ekta was telling us about, the issues there, down 2.5%. Divi's, Dr. Reddy's are all in the red. In fact, the entire pharma piece is taking a bit of a backseat this morning. TCS is also under a bit of pressure. Power Grid, Bajaj Finserv, Britannia, Bajaj Auto are a couple of other stocks that are in the red. ITC is also, just stepped back a bit, so down about 0.3%. Nothing alarming there. But otherwise, it's a market that's giving up on its gains a little bit. The drag, as I said, is coming from pharma, but from the heavyweights, the drag is Infosys, TCS. So IT continues to keep a lid on the market's gains. M&M, Maruti Suzuki, Tata Motors are a couple of other stocks that are in the red this morning. So, given how good the cues were, it's not a great opening, to be honest.
Well, that's right. Sonia, we're up 40 points from the high point of the day on the Nifty. Pat off the bat, and chasing that opening wouldn't have been very advisable. The Nifty Bank, that's going to be the crucial moving factor today. It's come off close around 100 points from the day's high. The high was closed around 42,470. You needed to get past that 42,500, 42,600. Resistance was met last week at both these two levels. So let's see whether or not we can get past that. Moving to individual stocks, Ami Organics, that stock is flying away. It's been a relative outperformer in the last 1 month or so. They've acquired 55% stake in Baba Fine Chem. They forayed into the semiconductor industry. The stock is up close to around 2.3%. Going by the press release, it appears that margin-wise, it'll be accretive, and obviously EPS-wise as well, it'll be accretive. Maharashtra Seamless, they're backed an order worth close to 260 crores, so those order wins continue from ONGC. That stock is opened up in the green. Sri Digvijay Cement, well, they've got an environment clearance for expansion of its manufacturing facilities. So, that's an important one that we're looking at. And we have some news that's coming in there. JM Financial Home Loans and Indostar Capital, they have explored for potential strategic options. So let's get both those two stocks up for you on the screen. So though the headline index has come off a little bit from the top, individual stocks have done quite well today.
Nigel, 30 points now, right? I mean, so this is a fair bit of comeback that we've seen already. But this is, the first act in what could be a multi-act, kind of day. But for now, we've come off quite a bit. The high is, 17,709. And we've come off about 50, 60 odd points already. Let me just take a quick look at any other sort of names in the broader market which sort of Warren mentioned. So HDFC Life, of course, is the big one, as we've been highlighting. 7.25% higher. Raymond is up about 6% or so. That's coming up at about 1,583 rupees on Raymond. Decent sized volumes. There is HBL Power, which is coming up with about a 4.25% gain. Small name, but big volumes at this point in the day. Macrotech, the management joins us in a bit, 2% higher, 927. There is Persistent Systems, which is up about 1%, 1.25%. ICICI Pru was the last from the ICICI stable, the insurance company report numbers where the management with us. ICICI Lombard this morning is up about 1.9 or actually 2% or so in ICICI Lombard. Mirza International, I was talking about this on Friday. It's up another 8% this morning. Stocks at 65 or 66. And there is Indigo Paints, which is up another 4% after the move that we've seen. I think Thursday and Friday, both Indigo Paints did quite okay. So 2:1 is the overall advanced decline ratio. And these are some of the big volume-led gains that we've seen. On the downside, Zomato is coming up with a 2% cut. Sun Pharma, we mentioned. Yes Bank, we mentioned, I think 2.5 lower. Adani Green is down about 1.7%. Adani Green at about 900. And there is Dr. Reddy's, which is down about 1.25% or so as well. PVR is down 1%. So things are moving around. Maybe we'll have more in a bit. I can spot PI Industries, which is down about 1.5% as well. So 31.45 on PI Industries. Hindustan Zinc is another one, which is down about 2.75% at about 315, 316. So volumes are still picking up. The market, which was, which sold off to being up only 30 points, is up about 45, 50 points now. So as I said, I think things will move around a little bit before they finally settle down. 17,675 or so is 17,675 is where the Nifty finds itself at.
What does it take for this market to to come alive, right? I mean, you had everything today. You had Reliance, ICICI Bank, HDFC Life, Wipro.
35% of the index reacting to positive news flow of the weekend, but
even then.
But I'll tell you guys, it didn't look, looking at all the numbers and everything, right? I was making this point that not that as if there's been huge earnings upgrades or anything, right? Across all these three names. We were mostly talking about the two earnings, ICICI and Reliance.
Yeah.
So it was that the sense was that maybe it'll get a flourish of a start and then maybe a little bit of a pullback. But let's see. I mean, the market, bulls and bears will try and test the waters to see how much of this holds one way or the other. So you don't want to push it too hard if the momentum is in the other side, and that's why usually it takes about an hour and a half for a market which is coming into with big numbers, earnings reactions to finally settle down and find some sort of equilibrium for the day.
Just one point. We're talking about the headline index. It's been a bit of a range, but the last few days, the mid cap and the small cap indices have started underperforming. And we had a good party in the first couple of weeks of April. So I'd like to see that come back, into form, because that's when portfolios feel good. And the last few days, we have seen some bit of underperformance coming in from the mid and the small cap index. But Prashant, our next guest is known as the master of mid and small cap. So let's go straight to him. Vineet Sambre.
Absolutely. Vineet is with us. He's head of equities at DSP Investment Managers. Vineet, good to have you with us here. Thanks very much for your time.
Hi, Prashant. Hi, everyone.
Hi. How are things looking, Vineet, to you? You've been cautioning about a little bit of slowdown in earnings at the margin. I remember after the third quarter, in the middle of the last quarter when we spoke, it's still early in the earnings season, but what are the trends that you're noticing?
So, Prashant, I think clearly, we are seeing some bit of moderation when we talk about the earnings because, largely linked to the consumption basket, and also more importantly, within the consumption basket, we are seeing that the entry level or the rural side or the bottom of the pyramid. I think that's the category which is sort of slowed a bit, and it is also maybe casting some bit of impact on the urban markets now. So I think there is some bit of that slowdown which is there. Maybe people are sort of wanting to save slightly more given where the inflation is right now. I mean, it is cooling off, but I think people just want to be on the side of a bit more caution, is my sense. But I think, as we move along, there should be 2 or 3 aspects which we are sort of monitoring. So first of all, I think over the next 1 or 2 quarters, the impact of this slowdown should be felt, and we should see the recovery post that. And even with a moderate level of recovery, I think what could happen is that the companies which were also impacted because of the higher input prices, those are seeing the benefits now. So I believe that even if we may slow a bit in terms of the overall top line growth, the bottom line growth should start improving. It may not necessarily immediately in this quarter or next quarter, but beyond that, my sense is that should start happening. And it will be a good positive if, let's say pre-election led spend starts to improve the overall consumption, the investments which have taken place till now, those start showing up in terms of improvement in consumption. I think that will be a double sort of a positive for the market. So maybe over the course of next 1 or 2 quarters, we may bottom out as far as the markets are concerned is my sense.
Okay, you may bottom out. I think that you're the second person telling us that this market may bottom out now. There was a global guest earlier in the day as well, Ed Yardeni, who said that the second half of the year could be much better than the first half. Just wanted to point out a couple of more stocks, right? Macrotech developers, actually the guidance was very strong for FY24. They spoke about a 20% increase in pre-sales. They're looking at 14,500 crores of pre-sales compared to 12,000 crores that they did in FY23. So the street is latching on to that. The other stock which I like is Scient this morning. So another 3% rally. Remember, Scient has put in almost 50% this year. So it's, outperformed all of its peers as well as done pretty well for itself. So these are just a couple of stocks in the broader markets. But Vineet, good morning and thanks for being with us on the channel. One thing is for sure that, there's a big trend that you're seeing where IT stocks have taken a backseat because of earnings and the impending recession, and banks have once again taken the leadership spot. Would you churn money out of IT and into banks now, or what is the most prudent strategy here?
So in fact, I think our overweight stance on banks continue, and we are watching that categories with more, let's say, carefully, because the fact is that, at some point, the NIMs would sort of peak out over the next 1 or 2 quarters, and then how the valuations at that point in time are will, drive our decisions in that category. But for the IT sector, I think, Sonia, for us, it has been more a long-term view which we have to take here. We had trimmed some bit of our exposure early on, and we are slightly underweight on the sector. But we would like to, eventually own, some bit more of the from the IT sector, because we believe in the long-term growth potential of the sector. Just that the current dynamics would lead to some bit of more valuation correction is our sense, and hence we are sort of on the sidelines at the moment. Maybe at better price points, we want to accumulate the stocks within the category. Now, within that, I think the large caps have come off quite well, and there I think there is some bit of bottom formation happening. If we consider their free cash flow yields, they have reached decent levels. But as far as the mid-cap pack is concerned, there I think still some bit of more stress looks like, given the fact that most of the end user is sort of again slowing, and the expectations around these companies are pretty high.
Hi Vineet, good morning. Nigel on this side. Vineet, it's been tough times actually for active fund managers. I'm looking at the performance of the last few years. Passive mutual funds, well, the returns have been a little bit better. My question to you is, given that we're in a challenging environment, and maybe the headline index doesn't have too much on the way up, do you think that this time around active funds will make a comeback, say in the next 18 to 24 months? Because that will be contradictory to what we have seen in the previous 18 to 24 months.
Nigel, actually, I would believe in that, given the fact that last 2 years were also extraordinary. It was very difficult to really factor some of the changes which were taking place across different sectors, the quick moves which are taking place. So I think in that sense, it was more a beta market, and, just being present in those categories at the right time meant that, you get good returns. But I think going forward next 2 years, I would agree with you. It is more fundamental driven market, where your assessment of companies and businesses which are likely to outperform should drive the outperformance. And hence, I would believe that if one is putting up the portfolio more in a rational manner, and trying to look for good prospects within that, I think stock selection should matter. And hence, there is a scope. I won't say that active will surely outperform, but there's a good scope for active fund managers to outperform over the next 1 or 2 years.
Vineet, you want to point us in the general right direction? If active is going to do well, it is going to be active stock picking, right? A few ideas, or rather point us in the right direction, general right direction, that will help. Where are you seeing opportunities now? Yeah.
So see, broadly, the way we are sort of thinking about looking at going overweight are, let's say, not focusing on sectors, but what are the trends where we are, putting our incremental capital. So one is that we are seeing a lot of companies which has made a decent amount of investments into capex in the last 2 years. I mean, last 2 years were difficult years in terms of the pandemic and all of that, but still there are a lot of companies which have done investments. Now, also the other fact is that while they have invested, they have not levered up the balance sheet. That is an important aspect. And in general, some of these companies have been generating decent ROEs. So I think that's a good combination where investments has happened, balance sheets are not levered, ROEs were good, and the growth is a bit slow at the moment for whatever reasons. So I think that's a good place to be in, because we will go by the management's instinct of seeing these investments paying off in terms of revenues, and that would also lead to higher profitability and higher ROCs as they move forward. So I think that's one pocket. The other pocket is basically where there has been a cyclical slowdown and the external environment has impacted some of the sectors. So as an example, healthcare is one sector where things were a bit slow, and the bigger impact was the profitability got affected because of higher input prices, higher freight cost and all of that. I think that's one category, and there are aligned categories similarly, agro-based companies and all of those, where the profitability has got hurt and the cycles were low. So I think that's one category where the cyclical recovery should play. The third category, broadly similar basket, is the automobile as a category, both auto ancillary, where not only India but world over we have slowdown and these cycles can change. So I think these are some, let's say, categories which we are sort of aligning our capital more towards.
Sure. You know, I was going through some of the funds that you manage, just taking an example of the DSP Mid-Cap Fund, right? You have a large presence in some of the spaces that have not done much for investors. For example, pharmaceuticals, you know, names like Alchem Laboratories, Ipca Laboratories, something in the specialty chemical space like an Atul Limited. These stocks have really not done too much, and there are concerns here as well. What do you do with spaces like this? Do you churn out? Do you keep the faith?
Yeah, Surya, so I think we are keeping the faith. And as I said in my last answer, I think these are some of the names where they have seen, extraordinary impact because of, as I said, maybe higher input prices, and which has hurt their profitability, which is normalizing now. And my sense is that over the next 1 or 2 years, we should see the mean reversion actually helping these companies. And within the names you mentioned, I think some of the specialty chemicals has done huge investments, not done in the last 5-7 years in their history. So I think those should also start benefiting these companies. So I think our sense is that we would like to keep faith in these names. And I think once these investments starts to benefit these companies, I think it will see its own, recovery in terms of performance as well.
All right. We hope for the sake of investors and for your fund that some of these stocks recover. Thanks a lot, Vineet, for joining in. It's been a challenging last 1 to 1.5 years. Hopefully things will get better from here. But let's move on to a strong set of earnings from macro tech developers. The profits rose almost 40%, aided by a tax write-back. Their FY23 pre-sales are up 34%. But I think what the street really likes is the fact that the FY24 guidance is very strong. A 20% growth is what they're looking at. Abhishek Lodha, Managing Director and Chief Executive Officer at Macrotech Developers, joins us now to talk more about that. Abhishek, welcome to the show and thank you so much for being with us. It seems to be like a purple patch that the premium real estate market is in right now. I mean, demand is up, pricing has moved up after many, many years. And your guidance is quite aggressive as well. A 20% growth is what you're looking at in pre-sales. Can you just take us through what the market trend is now? Do you see a lot of that guidance coming in primarily through a volume uptick, or is it a pricing up move that you're seeing flow through as well?
Good morning, Sonia. I'm great to be with you this morning. Last year, we grew our sales by about 34%. and therefore we have a high degree of confidence about the ability to grow at 20% for this upcoming fiscal 24, and also, in that same consistent manner beyond that. Our view is that we are in year 2 or year 3 of a long-term upcycle in residential real estate on the back of a number of factors, primarily being job creation, good wage growth, and good affordability. And that will keep driving this market forward, supported by the fact that the supply side continues to get more and more consolidated as consumers as well as lenders are focused on only interacting and dealing with a few branded high-quality developers. Our growth forecast for fiscal 24 comprises of a price growth. We like our price growth to be below wage growth so that affordability keeps getting better. So we're looking at a 6 to 7% price growth and the balance 13 to 14% coming from volume growth. This combination, we think, is a healthy combination of reasonable volume growth accompanied by reasonable price growth, which keeps everybody's situation better. Older home buyers feel better because prices are growing, and new home buyers are feeling good because they see an appreciating asset, but at the same time, they're also seeing their affordability get better because wages are rising faster than price growth.
All right. Hi, Abhishek. Good morning. Congratulations on a good showing, and you're looking quite confident with regard to the coming year as well. So let's see how you go about that. We'll get back to the operational performance. A quick question on the debt number. Normally, you give us a guidance on that front as well. But I think this time around, that's missing. So what's the debt number likely to look, say, in the next 2 years, 2024, 2025? And also repatriation of funds from the UK investment. By when does that come in?
We are now very, very confident and comfortable with our balance sheet. We've given an overall longer-term debt ceiling, which is 1 times operating cash or 0.5 times our equity, whichever is lower. We believe that we will keep going below that ceiling in the years to come, i.e. we will keep reducing debt from the current levels that we have. At the same time, our overall operating cash flow as well as equity levels will keep going up. So we'll be well below that ceiling. We are probably the only real estate company in the country who last year showed not only significant growth in terms of new business development, adding 20,000 crores of new projects and investing about 2,400 crores for the acquisition of these projects. But at the same time, we were also able to reduce our debt by over 2,200 crores. This combination of strong underlying operating earnings, which allows both deleveraging as well as investing in growth, is unique in Indian real estate. And we believe that we'll keep capitalizing on that same trend, i.e. growing and investing for growth consistently, but at the same time continuing to reduce debt. On the UK front, we repatriated about 550 crores from the UK last year, and the balance of about 550 crores will get repatriated this year. And with that, all our investments in the UK would come to an end.
Abhishek, hi, good morning. I think many would be very happy to hear that what you said, right? You believe you're only in the second or the third year of a real estate upcycle. And when we say an upcycle in real estate, it's thought to be longer. I mean, it runs for 7-8 years. Are we in that kind of an upcycle? Abhishek, I mean, what is your assessment? You've been in the game a long time. Or do you think it's a shorter one?
Hi, Prashant. I think it's a longer one. I've been saying this for quite some time now. Earlier, people were skeptical, saying it was pent-up demand and then, various other theories. But my view is that with 100 million new households becoming home ownership capable over the next 7 to 10 years, this is a once in a lifetime of a country's period for housing. Housing will drive India's transition from low income to mid income, and housing will also be a beneficiary of India's transition from low income to mid income. We think the cycle is much longer. It's not 5-7 years. It's like a 15-year cycle. Of course, there may be 1 or 2 bad years in 15, but generally it's a long cycle, much longer than we've seen in the past, because there's a fundamental shift in the fact that we have consolidated supply and increasing demand.
So where else is the Lodha Group going to go now? I mean, the Mumbai market is largely saturated, right? Forget about houses. There's hardly any place for people to walk anymore.
By the way, Sonia, I don't know if you're half familiar with this area, but around Matunga, I was driving down that highway, the Eastern Express Highway. And Abhishek, I noticed a very large project, a Lodha project coming up. I mean, I don't know how large, but it looked pretty, so to the point that where is the space? Yeah. And I was also surprised. Abhishek, you want to address that? That's a new project, right?
Yes, Shant, it is a new project. You of course keep your eyes very open. But to Sonia's point, I think if New York and Tokyo can find spaces for continued development, India is very early in its cycle, and we are going. There's lots and lots of space available for development and various other means in every city, including in Mumbai. Our market share in Mumbai is just around 11%. So there's a lot of headroom for growth for us in our core market of Mumbai. And equally now, Pune is starting to play an increasingly important role for us in our growth. So Pune will also be a growth driver for the next 2 or 3 years. We believe that Mumbai and Pune by themselves will, take our sales from the current levels of 12,000 crores to about 21,000 crores by fiscal 26. So there's a lot of opportunity just in our core markets. And then we have our pilot phase ongoing in Bangalore. That's going to be pilot testing, but something which over the second half of the decade will be another driver of growth.
I was more looking at where else are you setting your eyes on? Of course, Mumbai, Pune is something that you've looked at for a while, but Ahmedabad, for example, has become the hot property destination now. Hyderabad is picking up in a big way. Anywhere else you'll be expanding over the next 1 to 2 years?
Sonia, the way we expand is we, test the waters in any new market in a pilot phase, invest in building the local knowledge, invest in building a strong team, and only then grow. So that's where we are in Bangalore. It will take us 3 or 4 years for us to really become quote unquote local in Bangalore and then scale up. So that's really how we grow. We are not someone who, will go in and suddenly make a huge investment into a new market. We like to test the waters and only then expand. Those tips that you've given, Ahmedabad, Hyderabad, people have spoken about NCR, all of those are interesting. We'll be gradual in our approach. Current focus is Mumbai and Pune. And as I said, strengthening ourselves in Bangalore.
All right, Abhishek, always good hearing your thoughts. Thanks so much for stopping by. For me, the big takeaway is this time around, you believe that this real estate cycle will be for a longer period, maybe a 15-year period, in comparison to the traditional 5 to around 8 years that we have normally seen. All the best to you, and looking forward to having a chat with you all of the coming fiscal year. Well, time to move on then. Hindustan Zinc, well, they reported pretty much in line set of numbers. Both the revenues, net profit as well, had declined a little bit on a year-on-year basis, but that was on expected line. The margins were a little bit better as the cost of production dipped by around 6% on a sequential basis. To discuss the Q4 earnings and more importantly, the way ahead, we're joined by Mr. Arun Mishra, the CEO, Hindustan Zinc. Well, morning, Mr. Mishra. Thanks so much for joining in. Well, what are the odds you hit the upper end of that silver guidance of around 750 tons? I ask you this because the Pharma plant, you're saying it gets commissioned in the first quarter of FY24. So what's the guidance on silver volumes?
Yes, if the Pharma project comes on stream in Q1, and also we are looking at some amount of tolling of lead MIC and getting it converted outside our facilities, we will get back some of the residues, silver carrying residues, which will be processed here. Two together, yes, we are very confident of beating this guidance of 750 tons.
Well, you're guiding for some cooling off in the COP. So just give us some color on, coal sourcing mix and where do you see it headed?
When we started the year, last year, we had a huge difficulty in sourcing domestic coal. It went as low as up to 5% when the desire is to get 30% domestic coal mix in our coal fed to power plant. Also, at the same time, the imported coal costs were very high. Fortunately, towards the end of the year, the imported coal prices have softened. And also our domestic coal production increased, and accordingly, we also received quite a good percentage of domestic coal. It went as high as 26%. If I look at round the year basis, I am quite confident with the current productions of WCL or ACCL. So we guess that it will be around 20% of domestic coal we'll get. And with international prices currently about $150 a ton, should soften further, can go down to $130 a ton. So overall, we should see a good commodity price benefit coming to our kitty. At the same time, we are reworking all contracting costs, including mining contracts, plant operational contracts, so that we are able to reduce costs there by consolidation and redesigning the contracts. So and also some work on the mine plants and operational efficiencies. Altogether, we should be able to go down to 1125 to 1175 level. Effort should be to go closer to 1125.
Mr. Mishra, given the sort of the growth dynamics overall, the oncoming slowdown perhaps as well, globally speaking, what is your own outlook as far as zinc prices go, sir?
No, I think current range should be between $2,800 to $3,000 per ton, because we had expected last year there will be strong rebound of economy in China, UK, Russia, Ukraine war would not last beyond 2 to 3 months. We expected that American inflation pressure will move away, and Europe, demand will increase sharply. Some has happened, some have not happened. Russia-Ukraine war is still on. Uncertainty of energy sources is still there. China has not rebounded as sharply, and the current estimates world over is the demand for zinc is expected to grow only by 2.5% to 3% only. Fortunate part in India, the market remains still bullish. We saw good demand in Q4. There is a huge push by Government of India on infrastructure. Next year being election year, balanced infrastructure projects, there will be huge focus on completing them before the elections. And we guess that in India, the demand increase would be anywhere between 4% to 5%, far above than the global demand.
All right, and most of your sales will be in India, so that bodes well for you. But let's spice things up a little bit, Mr. Mishra. Now, going by the Government of India's communication on that they are not on board for Hindustan Zinc by Vedanta's international zinc assets. That's in the current form. Are you all working on some alternate strategy to convince the Government of India?
As far as we are concerned, it was a very good proposal, and it gives immediate boost to Hindustan Zinc's access to mineral. So it is still there, and we are talking to all shareholders. Government of India's letter says they expected us to explore more on non-cash mode of acquisition. So nothing is out of our consideration. We are studying all that, and I'm sure we will be able to convince our shareholders, and whenever everybody is on board, we will go for the regulatory approval.
Well, Mr. Mishra, you're sounding confident, but the other problem was valuations. It appears you were asking for peak valuations. Were valuations an issue?
As far as we are concerned, we have done the valuation fairly in a proper scientific manner. So I don't think there is any discussion on valuation.
All right, so you believe valuations is well fair. So you're looking at coming up with an alternative plan, is what the sense that I'm getting. What is the timeline for the outcome of these discussions that you're having?
Looking at the current conditions, we can't be putting a timeline, but I am sure it should happen sooner than later.
The one thing that the street definitely liked is in FY23, there was a big dividend that came through. So that's the next question. What is the dividend payout policy that we're looking at for FY24?
So while I won't comment on dividend, but otherwise fundamentals are still strong. Even if the price does not improve beyond $2,800 per ton, we will still be able to make a good cash flow of 10,000 crores at least after a year of operation with the guidance number we have given. So after that, it's up to the board to decide, and we'll leave it to the board to see whether with that earning, how do they want to use the cash. But we also have growth options open for us. We will be on the drawing board of 1.35 million ton and 1.5 million ton. With the current cash flows that I am talking about, 10,000 crores or even slightly more than that, the whatever net debt we have with that also can be wiped out. So I don't see any difficulty in the balance sheet for this company to grow further, whether it is organic or inorganic investment. And of course, remunerating shareholders is a decision of the board. We will leave it to that.
Mr. Mishra, last year what stood out was the big dividend payout. So that's why, my colleague asked you on that front. So let's see how that one goes, because you'll have to wait between capex as well as growth. Final question then, what's the update on the Government of India selling its near 30% stake in ICICI? We've been asking you this for the last few quarters. Any update? Is there an OFS in the works?
No, Government of India is on the job, and as far as whatever little I know of, they are looking at the right time for doing it. You must have observed our current stock exchange went through a lot of turmoil in the last few months, and at this point entering the market with 48,000 crore kind of an offer for 30% stake that they have, perhaps the market would not have the capacity to absorb. So right timing is needed, right quantum has to be decided so that the market can absorb that.
Sir, appreciate your thoughts. Thanks a lot for joining in and speaking to CNBC TV18. Let's do one thing. Let us take a quick break. The market has, by the way, given up all of its gains, and this is disappointing given that we had strong cues to wake up to ICICI Bank and Reliance. The market has not latched on to that. But let's do one thing. Let's take a break. On the other side, a special segment, Quarter Se Quarter Tak. Sonal will join in. She will give us a brief on what one can expect from the chemical space in Q4. We'll also have a chat with Rohan Gupta of Nuvama Institutional Equities to take that discussion forward. Stay with us.